Hey everyone, welcome back to the channel. Today, we're diving into something wild. While the headlines scream that the US economy is on shaky ground, American companies are showing surprising strength. So, what's going on? Are we headed for a recovery, or is this a trap? Let's unpack the latest economic news, figure out what it means for your finances, and share some tips to protect your money in 2025. Stick around, because this one's a game changer. First, let's set the stage. The US economy is sending mixed signals, and it's got everyone on edge. The big headline is that the economy shrank in the first quarter of 2025. The GDP dropped by 0.3% on an annualized basis, the first contraction since 2022. That's a red flag. A shrinking GDP means less economic activity, fewer jobs, and potentially less money circulating. A huge driver of this was a 41.3% surge in imports, as companies rushed to stock up before President Trump's new tariffs kicked in. Those tariffs? They're a big deal. The US is now slapping an average tariff rate of 23% on imported goods, the highest in over a century. That's making everything from your phone to your groceries more expensive. And it's not just imports. Federal spending, especially on defense, dropped 8%, dragging the economy down further. Add to that an inflation rate that's creeping up. Core inflation hit 3.5% annualized, the highest in a year, and you've got a recipe for uncertainty. Then there's the job market, and it's not looking great either. In July, the US added just 73,000 new jobs, the weakest growth since the pandemic. To put that in perspective, the average job growth over the last 3 months was a measly 35,000. Compare that to the 353,000 jobs added in January, and you can see the slowdown is real. The unemployment rate ticked up to 4.2%, and the number of people collecting unemployment benefits is rising faster than it has since early 2024. This tells us employers are getting cautious. They're not firing people left and right, but they're definitely hitting the brakes on hiring. And with Trump's push to cut federal spending, government jobs are disappearing too, 6 months in a row of job losses in the public sector. If you're in a government-heavy area like DC, you might be feeling this pinch. Oh, and let's not forget the consumer side. People are nervous. A University of Michigan survey from April showed consumer confidence at its lowest in nearly 3 years, dropping to 50.8. Why? Because folks expect prices to keep rising, 4.4% annually over the next 5 to 10 years, the highest expectation since 1991. That's a scary number when you're budgeting for rent, groceries, or a new car. The Conference Board's confidence index also slipped to 97.4, and fewer people think jobs are plentiful. Combine that with a 10% drop in the S&P 500 earlier this year, and it's no wonder Americans are cutting back on spending. Over half of US consumers are delaying big life plans, buying a house, going to college, even retiring, because they're worried about the economy. So, with all this gloom and doom, you'd think the economy is about to tank, right? Well, here's the twist. US companies are acting like they didn't get the memo. Despite the weak GDP, high tariffs, and a cooling job market, businesses are investing like there's no tomorrow. In July, orders for core capital goods, things like machinery, computers, and electrical equipment, jumped 1.1%, beating every economist's forecast. That's a big deal because these orders are a key sign of business confidence. When companies buy more equipment, it means they're betting on growth. Shipments of these goods, which feed directly into GDP calculations, rose 0.7%, and orders for things like vehicles and computers are climbing too. Sectors like electrical equipment and machinery are seeing solid demand, showing that businesses aren't slowing down, they're doubling down. Why is this happening? Well, part of it is that some of the economic fog is clearing. The article from Bloomberg Linea points out that companies are moving forward with investments as uncertainty around Trump's trade and fiscal policy starts to ease. For example, recent trade deals and a 90-day pause on some tariff hikes have given businesses a bit of breathing room. Plus, the Federal Reserve signals that it might cut interest rates by June or September 2025 are boosting confidence. Lower rates would make borrowing cheaper, encouraging companies to keep investing. But here's the catch. This strength in business investment isn't trickling down to everyday Americans, at least not yet. Let's talk about why this matters to you. On one hand, strong business investment is a good sign. If companies keep spending on equipment and expanding, it could lead to more jobs and economic growth down the road. That's the hopeful side. But right now, the reality is tougher. Those tariffs are driving up prices. The cost of imported goods, like electronics, clothes, even food, is spiking. Vegetables alone jumped nearly 40% in a single month. That hits your grocery bill hard. And with inflation at 3.5%, your paycheck isn't stretching as far. If you're thinking about buying a home, car, or taking out a loan, high interest rates, stuck between 4.25% and 4.5%, are making it more expensive. The Fed's in a bind. They want to cut rates to boost jobs, but they're worried about inflation getting out of control. Then there's the job market. If you're in manufacturing, professional services, or government work, the slowdown in hiring could make things feel shaky. And with Trump's immigration policies kicking out some foreign workers, industries like construction or agriculture might face labor shortages, which could drive up costs even more. For younger workers or recent grads, the job market is especially tough. Unemployment among college graduates is creeping up, and companies are leaning on AI to cut costs instead of hiring. If you're job hunting, this could mean fewer opportunities or stagnant wages. So, what can you do to protect your finances in this weird economic moment? Let's break it down with 5 practical tips. Number 1. Build a bigger emergency fund. With the job market cooling and prices rising, you need a buffer. Aim for 6 months of expenses, not just 3. If you're earning $3,000 a month, that's $18,000 saved up. Start small, cut out one streaming service or a few takeout meals and redirect that cash to savings. Number 2. Shop smart to beat tariffs. Imported goods are getting pricier, so look for American-made alternatives. For example, instead of buying a foreign-made phone, check out brands with US manufacturing. Compare prices at local markets or bulk stores to save on groceries. Even a 10% savings on a $200 grocery bill adds up fast. Number 3. Invest in resilient sectors. Companies in tech and healthcare are still hiring and growing, even in this economy. Consider ETFs or stocks in these areas, like the iShares US Healthcare ETF or tech giants betting big on AI. Just don't put all your eggs in one basket, diversify to spread the risk. Number 4. Lock in loans now. If you're planning to buy a car or refinance your home, don't wait. Interest rates might drop later in 2025, but they're high now, and waiting could cost you. A fixed rate loan protects you if rates stay elevated. Number 5. Upskill to stay competitive. With AI replacing some jobs, focus on skills that machines can't touch, like creative problem solving or leadership. Online courses in data analysis or project management can make you stand out. Sites like Coursera or LinkedIn Learning have affordable options to get started. Here's the big picture: US companies are showing guts, investing despite a rocky economy. That's a glimmer of hope, but it doesn't mean smooth sailing for your finances. Tariffs, inflation, and a tight job market are real challenges. The key is to stay proactive, save more, shop smarter, and invest wisely. So, what do you think? Are you feeling the pinch from higher prices? Or are you optimistic about a recovery? Drop a comment below and let me know how you're navigating this economy. If you found this helpful, smash that like button and subscribe for more updates on how to keep your money safe. Until next time, stay smart with your finances.